Hello, and welcome to a new podcast series, Cash Flow Conversations, sponsored by Nova Credit. Now, if you've read or listened to anything that I've created in the last few years, you'll know that cash flow underwriting and the use of cash flow data in lending more broadly is a topic that I am fanatically interested in. Quite literally, Winston Churchill once said that a fanatic is someone who can't change his mind and won't change the subject. Well, I think that cash flow data has enormous potential to positively reshape consumer lending in the US. I won't change my mind about that. And I have no intention of stopping talking about it. However, the conversation about cash flow data in lending isn't static. It evolves as the industry matures and as more and more banks, credit unions, and fintech companies move from the theoretical, hey, cash flow data is interesting, to the practical. Wow, cash flow data is more valuable and more challenging to use than we thought. That's what this series is going to chronicle, the evolving conversation around the use of cash flow data across the consumer lending lifecycle. Now, this first episode is a fun one. It's actually a recording of a panel that I moderated at Nova Credit's Cash Flow Underwriting Summit, which was held earlier this month. The panel was about the realities of dealing with cash flow data from the perspective of credit risk executives who are in the process of incorporating it into their lending systems and processes. And as you will hear, I had some great credit risk executives on this panel. Chris McCall, head of consumer credit and pricing at Citizens Bank, Bill Garber, SVP credit policy and analytics at Navy Federal Credit Union, and Munish Pahwa, EVP and Chief Risk Officer at Sallie. Chris, Bill, Munish, and I talk about the differences between cash flow data and traditional credit data. We talk about the implications of using this data on lenders' analytic models, borrowers' experiences, and the compliance and governance processes that govern all of that. And most importantly, we talk about the growing importance of developing a better view into the financial lives of consumers in today's uncertain economic climate. I hope you enjoy listening to our conversation as much as I enjoyed facilitating it. So, here is episode 1 of Cash Flow Conversations.
It's nice to come out to some applause. It's a good energy to start with. I am delighted to get the opportunity to moderate this discussion. The challenge I'm going to have, which I think is the same challenge all of you will have, is that I'm going to want to ask questions and more questions of these guys. But we also are the last session before lunch. So we're going to deal with this tension together between wanting to extract as much insight as possible from these three, but also wanting to get to lunch. The Q&A function has been fixed. We will see questions come in. So if you have any questions, feel free to submit those. Before we get into the risk journey that you're all on with cash flow underwriting, would be great to just get a more general sense of who you are, your institution, in case anyone isn't familiar, and where you are right now in your cash flow underwriting journey. So why don't we go down the line?
Yeah, thanks. I'm Chris McCall. I'm the head of consumer credit and pricing for Citizens Bank. We're, as an institution, relatively early in our cash flow journey. We're beginning to assemble our very first data sets for analysis across a number of our products.
Awesome. Bill?
Hi, I'm Bill Garber, Navy Federal Credit Union. We're the largest credit union in the world with almost $200 billion almost in assets. I head up credit risk management, both on the risk-taking and on the reserving side. Our cash flow journey is in the middle, similar. We have exchanged data. We sort of have engaged a lot on the experience side. We are partners in that space, and we have one use case, but we're also sharing data around other possible use cases because there's a lot of interest, and so we want to really be able to hit the ground running.
Perfect. And Munish?
Munish Pahwa. I'm the Chief Risk Officer for Sallie. Sallie is an education services company. We offer student services from selection of college, scholarship, additional information, and we also give private student loans. We are the largest in America and proud of that. where we are in the journey, we are at the very initial stage, just like Chris, you mentioned. So I'm looking forward to learning from all of you today.
Outstanding. Well, we're going to get into a lot of nerdy detail, but before we do, I did want to ask the three of you what you thought of the presentation this morning on macroeconomic conditions and the risks facing consumers. Obviously, it's sort of vacillated, I would say, between realism to pessimism to maybe some slight signs of optimism. Let's just go down the line real quick. Munish, you want to start?
Yeah, thank you for that question. Our demographic, the customers we deal with, are 18 to 30 years old primarily. So it's a little different view. There's still a lot of excitement. The college education pays well in America. There's a good return on investment. Of course, there's some slowdown, as was discussed this morning, no doubt. But we do believe eventually a college education is a very good investment. I just want to add one thing. We do a couple of studies called How America Pays for College, How America Succeeds in College, and then Succeeds After College. They're all in public domain, so if you haven't seen them, they have a lot of good information. Link with me, and I usually post on LinkedIn, so you can get them as well.
Awesome. Bill, how about you?
Yeah, I really enjoyed that the conversation this morning because it really does capture the essence of what makes our job challenging and interesting at the same time. We've, I think, excised the word normal in our conversations these days because there is no normal anymore. COVID has been, and the post-inflation period has been enormously challenging in trying to figure out risk, which is why the cash flow space is so important to try to better understand the risk profile of what our borrowers are experiencing and what they're likely to do in the future. So whether we're, yes, risk is improving, but it's stabilizing, but at higher levels. And so the predictability and what the data actually means and compared to the past is a constant struggle.
Yeah. Chris, I know you missed the presentation this morning, but what's your view on kind of what's happening with your customers versus the kind of broader macro picture?
Yeah, I think one of the interesting points is that there's not a focal point for where the stress could be. A lot of different things. Inflation, you worry a little bit more about the lower side of the market. We tend to skew a little bit more up market, and so the jobs report is obviously getting a lot of attention right now. And then obviously both of those things translate over into the small business space as people experience affordability and their own potential income problems. So hard to tell where it's going to go, but there's certainly a lot of different things to be thinking about no matter what segment you're in.
Yeah, I thought it was fascinating this morning. Amy mentioned that sometimes the data just doesn't show up the way we expect, right? Small business, instead of declaring bankruptcy, they might just close their doors and stop answering calls. Like that is happening, but it doesn't mean it shows up in the data that we rely on. So let's talk about data and the different ways that we can use it. I wanted to start with a really simple question, which is cash flow data from a risk perspective fundamentally different from credit data? And let's go down the line again. So Munish, we'll start with you.
Yeah, thank you. As I shared, student lending is a unique asset class in consumer lending. The customers are 18 to 30. The product is unique. Some of them don't pay. It's a deferred payment. You don't pay for years. And when you come out, there's a grace period at times. So back to your point, cash flow data, it is absolutely imperative that we understand that because we are dealing with thin file, no file, and income that will come later, but absolutely it can help us understand better money habits. So it's absolutely, it's extremely important in the business line where I am.
Yeah. Bill, what do you think? Is it fundamentally different? Is it similar? What do you think?
So maybe at a high level, what I would say is that the nature of the data itself is not tremendously different in how you might use it, but the ability to use it is different because there's so much experience with the credit file and what that data means. So having a good partner to be able to interpret the micro details of it and make sense of it so that it is consumable and usable is one of the big challenges. There's other issues which we've talked about as a group a little bit about the fact that with traditional credit data, you can do retros because the credit file is existing. With consumer permission, you're in a really different space. So that's another dimension in how you use it and how you implement that's going to be really critical to thinking through all of the different possibilities and what you're prepared to do or not do in the space.
Yeah. Chris, how about you?
Yeah, I mean, I don't think it's really different at all.
Yep.
Different things within a consumer's credit bureau give you different perspectives on the health of a consumer, their financial position. Income is just another part of that picture. Mm-hmm. And so, I think there are some viewpoints that it's, alternative data, and I really think it's just another component in the view of a customer or a business.
Yeah. So let's double click into that in terms of how you use it, Bill, going back to your point, how you implement it. I mean, the retro, that comes up a lot, right? In terms of back testing and trying to understand how the performance works. There are different ways, I think, to potentially solve for that, or at least mitigate some of the unknowns there. We'll go the other direction here. Chris, starting with you, what's been your experience trying to navigate that particular challenge?
Yeah, I mean, we have an advantage in that we are a bank.
Right.
And so we have a lot of on-us data, and that is a reasonable place to start where effectively we have the input for retro. It's in our databases. As we think about off us, that's, it would be easy to go that, well, those insights poured over, that if you're getting
Sure.
The income from other institutions or these are off you, it all means exactly the same thing. Mm-hmm. And that's something that from our perspective, we'd like to test into, but how aggressively you want to do that is a question of risk appetite.
Yeah. Phil, how about you?
Yeah, I would echo a lot of what Chris was saying. I think that for us, and that's some of the data exchanges leveraging the on-us data, and Navy Federal has a high number of percentage of our members who use us as our primary financial institution. But back to whether it's different, we've had access to that data all along and have incorporated it in various ways already. Having this is helpful. But the question then is, does your off-us perform the same way when you use that data? And we know that our members who use us as their primary financial institution tend to, we're the last ones they stop paying. Well, is that going to be true, and to what extent? Which again ties back to what your initial use case is and how you think about being as nimble as possible as you implement to be able to adjust on the fly. You don't have the normal, well, we're going to wait, we have the scorecard, we put it in, and we're going to wait, 18 months or something, and then we're going to see how it's doing and whether it works. You have to be prepared for that and have those conversations internally so that everybody's on the same page.
That's a great point.
I think both Bill and Chris have answered a lot of things I would have said from a process perspective, but I'll share a slightly to everything that is being said, a slightly different perspective. We do not have as much data on our customers internally. We are a single product lending firm. So we don't have deposit, card, etc. So it's absolutely valuable. It's absolutely valuable. So back testing, of course, we cannot do it because we don't have that data. We'll have to learn through it, walk before you run. But absolutely, we are looking at margins, how we can, what I would say, enhance our access. And that's important.
So I didn't prep you for this question at all, but it occurred to me, from a risk perspective, and obviously you guys partner on the business side to figure this out, and we're going to talk more about how you build kind of the business case internally. But from a risk perspective, how do you evaluate different use cases, particularly when you're starting and trying to figure out okay, given some of these unknowns or given some of these challenges, and Bill, I loved your point about, just because the on-us data tells us about how they treat us, well, that doesn't mean that someone who doesn't have on-us data will treat us the same way. There are assumptions that you can't necessarily know in advance. How do you think about applying those unknowns to different use cases, and where might be a safer place to place a bet or to try to learn? And Chris, why don't we start with you again on that?
I don't think so much about what the safety of the use case, it's where the business opportunity really is. And I'd kind of go back to how
business people applaud that answer. That's the right, that's what you want your risk officer to think in. That's great.
No, I mean, you want a balanced view, right? You don't want to lose money, but again, I think it's prudence and what is the scope of the test, right? What are the key assumptions that really need to be true in order for that application to work? How much data do you need to read that? How long is that going to take you? And ultimately, how much do you want to bet before you're, really certain? So,
sure.
I don't think I would prioritize it based on what's safe. I would prioritize it based on what's business relevant.
And is there an example in your institution where you're thinking of maybe getting started earlier relative to others?
Yeah, I mean, I think card is a very attractive use case for us. I think we're thinking about it across all the different business lines. And I think one of the challenges that we had was that all the business lines were simultaneously interested, which, for us was a little bit overwhelming. We couldn't support that capacity. And so we had to sort of decide what we wanted to go first. And we looked at card originations as a place where we might be able to make some attractive swaps on the margin.
Awesome. Bill, how do you sort of evaluate use cases?
Yeah, I think it really is, it's that nexus among organizational readiness, not just from, and business opportunity, organizational readiness, not just from the portfolio and the product area, but from the front end and so you may have a product that has a developed space in which you have an interaction with your incoming applicant that is amenable to that. So I think it's really around getting that triangulation. And as an institution, Navy Federal, we do have a desire to find ways to say yes, right? And so where that space is and what we're trying to build in terms of a long-term partnership with our members really informs how we thought about it.
Yeah. Munish?
I think the 2 points touched upon, business case and then customer advocacy, where it makes easier for customer to use such a data, right? You can do income verification, you can ask for questions, but if you can do it in a frictionless manner, it's fantastic. So those two dimensions, absolutely. What I would also say is, each data, and I'm getting a little nerdy here.
Please do.
Each data series within it has certain signals. So cash flow data, of course, has great signals for income, spend, and if you take the two and derive liquidity, right? And you're absolutely right. Relationship, whether you're using somebody's card, you have a relationship, etc., affinity. But those three signals may be used effectively in acquisition, collection, underwriting differently. Income may be used in line increase without an affinity to the relationship. So it is also imperative as risk officers and as business officers to think about signals and then think about where it applies with the business case.
So a question that came in that I think is actually relevant to this part of the discussion is from a risk perspective, how you think about the accuracy of the cash flow data, right? And you could look at this from a bunch of different perspectives, right? You could look at different asset classes. You could look at it from the perspective of on-us versus off-us data. And, I don't think this is in some ways that different from what we already deal with in the credit bureau space, right? I've written a lot about the fact that the credit bureaus don't always have great data, or the data might be somewhat misrepresentative of what's actually happening. So as you sort of explore this new category of data in a lot more detail, how do you think about questions around accuracy and how it reflects reality? Bill, I'm going to jump right to the middle on that one.
Okay. So my first reaction is don't let the perfect be the enemy of the good, right? So I think enhancing your transparency around things is only going to get you to better decisions. I think there's trended attributes. There's all kinds of things in which you're making a calculated decision around your tolerance for the noise.
Right.
And the other thing to think about maybe is around the use case, right? So if you're doing it in terms of finding ways to say yes, then yeah, there might be pockets of people who you haven't been able to say yes for, and there are going to be a certain amount of risk for where maybe the person looks a little bit better, but as long as you size it properly, then it's no different, back to the initial question around regular credit risk management. You're just having another set of data and information that you're deciding how to use and incorporate into your business model.
Yeah. Munish, anything you want to add?
I'll say exactly where you actually ended, that it is financial data, so in that sense it's same.
Sure.
The characteristics of the data are different. So I think let's distinguish that from accuracy. It's a high speed, high frequency data. And when you have that, there's seasonality. There could be a contractor getting income every X months, and you may say, hey, is that accurate? Maybe it is.
Sure.
There is seasonality, there is a trend. There are also what I will call event triggers in there, a lot more. In bureau, maybe it happens slowly, the delinquency happens 30, 60, 90, the income may stop next day.
Yeah.
So that may be questioned as accuracy or characteristic, but I see value in that.
Sure.
So it's a slightly different kind of a twist to that question.
Yeah.
But I think the characteristic of that data should not be confused with accuracy to some extent. In the model, sometimes it is.
It's a great point, right? And Chris, I'd love to get your perspective on this because, I mean, sometimes it's hard to distinguish between this data is different than what I'm used to versus this data is not accurate or doesn't tell me something. So how do you think about that in terms of like when you're building attributes, you're building models, like how do you take that into consideration?
When traditional credit data falls short, lenders still need the right insights to make their best decisions. That's where the credit infrastructure and analytics company Nova Credit comes in. Think of Nova Credit as a next-gen credit bureau, turning alternative data into reliable insights for smarter, more inclusive lending. With Nova Credit, you can confidently deploy cash flow underwriting and grow responsibly. Learn more at novacredit.com.
Yeah, I mean, I would compare it against things that are static, right? So if you took a pay stub as an example, you're getting a point-in-time snapshot.
Yep.
Whereas being able to work off of the entire bank account does two things for you. It gives you that, time series view, and you can decide, am I suffering from volatility? Did somebody have a really good month on a commission job? Did a bonus come in? Is that accurate or not? Well, I would say it's accurate, but it's potentially not complete.
Right.
There's also additional things that the bank account data can tell you that something like a pay stub can't, right? You can look at, the outflows, you can look at liquidity. There's a number of different things that you can get in that data that I would say are potentially, they're not more accurate, but they're more complete.
Right.
The one thing I would say on accuracy is the document falsification thing. If you're collecting manual documents like pay stub, you have to worry about if they've been altered, and with cash flow data, you just really, if it's permission.
System to system, yeah.
Right. There's, not no concern, but there's a lot less of a concern.
Right. Yeah. It's really, really hard to fake cash flow data, right? And I think that's sort of fundamentally an advantage in a lot of ways. I did want to ask you guys about compliance and risk management, right? Because I think, obviously, I know Nova Credit spends a ton of time on this area and helping clients in this area, but that's a huge, I would kind of categorize it almost as sort of a gray area or an unknown because, credit bureau data and scores are really old, right? Like we know a lot about what we're allowed to use them for, what we're not allowed to use them for. And to a certain degree, the data itself just doesn't have the same level of granularity. And so even if you wanted to build an attribute on something, the data just might not be there to do it, even if it would be predictive. Now we have the opportunity to build a great deal more granularity and look for signal and look for patterns. How do you balance that, which is kind of your guys' job, against model risk management, compliance, sort of those things? Munish, why don't we start down there and we'll come with this one?
Yeah, I think great question. Both those are important. Having said that, I will say getting a product like we are talking today makes it very easy.
Yeah.
I think, Chris, you touched upon if you're collecting pay stubs or income verification, whatever you're doing, there are a lot more compliance, data storage, et cetera, control requirements that come with that. So that's one. The second part I'll say here is, especially in the space where we are, specifically fair lending becomes an issue because 70-80% of the students or a higher percentage comes with a cosigner. Now, if you're saying, I'm going to consider your income versus cosigner, am I combining, giving different weightage, annualizing, because students get 80% of their income in summer versus you may not. So fair lending is a very important topic that you're bringing up, and I agree with you. But model compliance, I think we have crossed some of those bridges and solved for some of those things in a positive way.
Yeah, those things apply. Bill, how about you?
Yeah, I sort of talk about the model risk side and then maybe the compliance side. On the model risk side, I would put it in that category of things where we're having internal conversations about this, where with AI and explainability and like, where is this fitting in? In some ways, cash flow is on the more accessible side for it, other than the fact that, again, without being able to retro and seeing and understanding, and we have a third party, there's some challenges. The regulatory side is interesting in a couple of other ways. I think adverse action around this stuff is something we talk about as an institution, about being able to tell the consumer or our member who may be denied not only why, but give them agency in terms of what they can do to get better. And so you can address that through a number of other enablers to have people manage their credit. A lot of institutions do that, but that's where, again, that would inform the use case, and as well as, do you want to go into the adverse action space? Because what do they look like? And is it really something that, and especially if you're trying to build that relationship with the consumer, with your member, does that leave a bad taste in their mouth that affects the larger holistic relationship? And that's something that we think about a lot.
Totally. Chris, how about you?
Yeah, no, I would think very much the same way, that I like the point around like explainability and fairness to customers, and it depends on the product, right? Like, you take something like an auto loan and, somebody has a relatively low income. It's like not conceptually unreasonable to say that, like, you make $30,000 a year, you can't afford it, a $200,000 car.
You're like, come on, man.
Right. But I think, the point around adverse action is important, because cash flow data allows you to do some things that you couldn't with other forms, right? So if you say, you talk about income, if you're using stated income, adverse actioning off of that is just inviting someone to say, well, I know what to write on the application next time.
Totally.
That problem doesn't present itself with cash flow data.
Yeah. No, that makes sense. Yeah, I'll just write a higher number. So we've had a couple questions come in that pointed an area I wanted to get into, which is how this applies specifically to your customers or members, right? Because generically, I think we can all understand cash flow data, really useful. It's orthogonal to credit data. It applies across a wide variety of different use cases. It persists now across the life cycle, which is great. However, much like credit data, when you're applying it to your institution, your portfolio, your customers, your products, certain things probably jump out a little bit. And we've had questions come in around, like with student lending, a lot of these folks are younger. They both don't have traditional credit data, but they also might not have a lot of cash flow. And they have co-signers and parents. I imagine like military families have their own dynamics. Chris, as you're describing, like, there's lots of different segments of consumers. We have a question here about the gig economy and pay stubs and W-2s. So as you think about how it applies narrowly to who you serve, kind of what comes to mind? And Munish, we'll start down there.
Yeah, I'll go back to what I was saying, the signal within the data, right? There's income. You're absolutely right. Students may not have income. They do have spending. They digitally use debit cards, credit cards. They spend. Maybe not the first year of college. By the time they're hitting second, third, fourth year, they even are renting. So the data starts coming. It's getting richer and richer, one. And I'll go back. So the way we would think of it is better money habits. Can they manage their money? Their capacity to pay will come, but the character of payments is that there. So that's the signal we are looking for. And as I mentioned, when they are coming out of their student education degree, they're out of the deferred period, the payment starts. At that point, it becomes even more important. As they're getting their income and spend go up, it becomes important for us to know that if they're in grace period or what kind of a payment program will they be on. So both ends of the program, acquisition, better payment habit, and then income a little later when they're graduating.
Awesome. Bill, how about for Navy Fed?
Yeah, it's an interesting question. I think for us at Navy Federal, the military side of it is interesting because there is a certain category of active duty military where you have a degree of certainty around things, their performance is longstanding. But even that population, and that's only a percentage of our overall membership, because we get them after they stay with us or after they leave the service, and then they enter the general population. But even the military members, we talked about BNPL earlier, right? So you can see these transactions happening and you don't always know how to interpret it. We have some insights into it, but having the overall model around cash flows that you're getting from Nova and from the use of that data applies across of our field of membership. I think it's more about building that long-term relationship, and somebody else mentioned the word of trust. And so what we're trying to do, that's part of our brand, is to get our members to trust the relationship with us and then to be more likely to buy in and be comfortable with the consumer permissioning and our ability to use it for their benefit.
No, absolutely. Chris?
Yeah, so I'd say we're a relatively decent-sized regional bank with multiple lending product lines. So we serve full spectrum of the American public with different products, and it is really use case specific. The relevance of cash flow to assessing consumer risk, very different for a thin file than maybe for an 800 FICO, and we have to think about all of those. That's sort of the risk assessment side, and then you also have line assignment, which that applies to a lot of different products. So it really depends, and we have to think about all of them simultaneously because we have so many different segments and products.
Yeah, absolutely. I could keep going and going, but we're almost out of time. So to wrap up, I would like each of you to kind of talk us through lessons learned and maybe a little advice for the audience on building a business case, herding cats internally and creating alignment, like avoiding easy mistakes. What's one thing you want to leave the audience with as you've progressed through this cash flow journey? And Chris, we'll start with you.
Yeah, I think when I joined, there was a lot of interest across multiple product lines. And for us, the challenge was one of prioritization. There were a number of different use cases in different products. And if you kind of adapt, you're like, well, this is a little bit too big to go after. There's very fundamental things like how do we transmit data? So can we figure this out on a unit of one? Can we work out some of the problems of how to understand the data, build sort of the muscle, and then as we get really comfortable with it, then we can start working at moving across different use cases. So I think narrowing the focus would be my biggest takeaway.
Love it. Bill?
Yeah, there's a really difference, and back to the initial question around difference between traditional credit file and the cash flow space, where credit file, you get a new model, you get a new score, you just go through a governance process and model risk, and then boom, you're ready to go. You do have potentially an implementation challenge on the system side, but this is of a different scale, I think. And so I think it really is around triangulating around getting where does it fit into the overall vision and strategy for the company as a whole, and trying to figure out how you can make the case for it is consistent with what that is, and then building the connections, figuring out what the navigation is around the technology side and what the organization's direction is there, the experience side, the product that you want to start with, and then the strategy office itself, and getting all those cats herded, and then getting the consensus, and then advocating for it in terms of all the other important and useful things that the company wants to do.
Yeah, absolutely. Munish?
Yeah, I think a lot has been covered, but there are three dimensions to it as we saw it in our journey, Sallie Mae. The first is to get the partners across the company together. If you notice, our product manager, general manager, Pat is here, our chief credit risk officer, Jeff is here. So
all right.
It's a good idea that we all came here together to think about it together. So importantly, I think that the vision, this is something new. We are used to using traditional credit bureau data. When something new comes, it's better to get everyone first aligned in the vision of the company where you want to go. So that's one, business case, the vision. The second is the customer.
Yep.
Absolutely, we'll have to make a decision where we are helping the customer get better access or better completion, whether it's debt payment, success, or whatever it is, right? So it helps the company. The partners are aligned, there's a vision. The customer, it is helping them. The third is the implementation. Today or tomorrow, whenever we use it, we will be using as an overlay. second look in that fashion. But the true value would be the day we start integrating in our models. The high frequency data, Alex, you touched on it. A lot of it was discussed. That is where the true potential will come, but it's better to test, walk before you run. So that's implementation. So partners are aligned. It's a great thing for the customers. We are thinking through implementation.
Perfect. Well, that's a great place to leave it. Please join me in thanking these guys.
Thanks so much for listening. This episode was brought to you by Nova Credit. They're a credit infrastructure and analytics company and a CRA, helping businesses grow responsibly with alternative credit data. Confidently deploy cash flow underwriting with Nova Credit's proven platform. Learn more at novacredit.com.